I am certainly not in fact, I'm probably not even the first person who's parsing these kind of arcane Bureau of Labor Statistics quarterly census of employment and wages and benchmarks and bed analyses and state level payrolls. That's the job primarily of Fed staffers, and I'm sure they've been crunching the numbers and doing all the research, and that their heads, may be more bruised than mine.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Suddenly, the Federal Reserve is filled with more drama and curveballs than a World Series tiebreaker. The betting markets are abuzz debating who President Trump will replace current Chair Jerome Powell with. A surprise resignation from Fed Governor and FOMC voting member Adriana Kugler has added Trump loyalist Stephen Mirran to the inner circle. And another FOMC voting member, Governor Lisa Cook, is now in the crosshairs due to a purported mortgage fraud scandal and is at risk of being replaced. On top of all that, Jerome Powell gave a significant indication in his speech at Jackson Hole last week that rate cuts are indeed coming ahead, likely starting next month, due to rising concerns at the Fed that the economy, labor force, and housing market are weaker than it previously appreciated. To make sense of all this for us and the likely implications, we're fortunate to welcome back to the program Danielle DiMartino Booth, CEO and Chief Strategist for QI Research and author of the book Fed Up, an insider's take on why the Federal Reserve is bad for America. Danielle, thanks so much for joining us today.
It's great to be here, Adam. I'm happy that some of the dust has settled on Jackson Hole, but from what I heard from participants, it was not all about light and airy and conviviality this year. It was a little more tense.
Okay, well, why don't we start there with Jackson Hole? So Powell got up there, interestingly, kind of delivered exactly what the market had been hoping for and really, honestly, I thought had been pricing in, but clearly not because we had a bonkers day in the markets on Friday. Pretty much every asset class everywhere was up dramatically. Selling off a little bit here at the start of this new week. But he did mention in his remarks that, the economy was weakening faster than the Fed thought it was earlier in the year and more or less, gave the impression that he's going to start cutting rates next month. So how material is it that he is acknowledging that the economy is now not as rosy as he's sort of been saying it is in all of his press conferences so far this year?
I think I don't think it's what you would consider to be kind of this 100% pivot.
Mm-hmm.
But at least it's an acknowledgement of the reality that so many others have been seeing, that it was almost a relief that he said anything at all. There was a lot of fear going in that he was just going to be just to stand on his principles and insist that the labor market was solid and come what may. And it was just refreshing to see just a tiny little hint of reality enter his narrative. For any number of reasons. I mean, Adam, I've been banging my head up against this wall for some time now.
Well, I know you have, yeah. So it's got to feel good to you to see some validation there.
Yeah, I mean, look, there are so many. I am certainly not in fact, I'm probably not even the first person who's parsing these kind of arcane Bureau of Labor Statistics quarterly census of employment and wages and benchmarks and bed analyses and state level payrolls. That's the job primarily of Fed staffers, and I'm sure they've been crunching the numbers and doing all the research, and that their heads, may be more bruised than mine.
Well, I mean, look, I'm gonna try to reserve, bashing the fact that the Fed has hundreds of PhDs, and yet you're just one analyst, Danielle. But it seems like, it's finally, as long as it's taken, they finally started coming over to see the world the way that you have been. And Powell, to your point, in his press conferences so far this year, has said, hey, this is yes, things are coming down. The labor market is cooling a little bit, but this is all normalizing. This is nothing that we see as worrisome. And I will say, as the year has gone on, the questions from the press corps have become more pointed than they've been really in recent years, of people just being worried about economic slowdown risk, what they're hearing anecdotally or seeing with their own eyes in the jobs market. And again, Powell seemed to just sort of shrug a lot of that off. Now, again, it's his job to project confidence. He
Mhm.
doesn't want to freak people out, but still,
Yep.
I think it's got to be somewhat notable that he is finally saying, you guys actually might have something, you might be onto something there. But let me ask you this. So, Powell has long said in all of his conferences this year, his press conferences, hey, we've got a dual mandate. We've been really focused on inflation because that's been the big problem. Job market still seems, okay to us. We don't want to make the mistake of cutting too soon, especially when we don't know what the impact of these tariffs are going to be. And we think that they could be driving prices up. So we really want to be sure about that before we start cutting. Is this beginning to end the debate on how inflationary tariffs are going to be if indeed the Fed starts cutting now?
I don't, it certainly doesn't sound like it's ending the debate for the individuals who are insistent that tariffs are going to see pass through. I think it does end the debate for those of us who can see the weightings in the CPI, understand what's happening in shelter is not happening in isolation, and can also, it is very visible to the naked eye how very much uh, pressured spending is on anything discretionary, whether you're talking about goods or services. We ran services inflation on a year-over-year basis, uh, and we netted out healthcare, utilities, um, and shelter from that. We netted out the three things you have to pay for, right? You
Right.
presumably you have to cool the house when it's 105 degrees in Phoenix. You have to put a roof over your head, and you absolutely must have to tend to healthcare. These are the three things that are in that big services bucket. When we took those out, year over year, services ex essentials is at negative 0.19% year over year. This is the lowest level. Forget COVID. This is the lowest level since the Great Recession.
Wow.
And it goes to show you how little money people have after they spend on food and energy and on what they have to spend on. And that's exactly what I think in many ways was ignored, that Target said last week. Everybody's like, oh, that's Target. They're Target's losing the game because all they sell is stuff people want. But it was also Doug McMillon and the CEO of Walmart saying, you know, our our customers are buying essentials. If they are buying discretionary goods, they're buying them on clearance. We are benefiting by gaining market share because upper income people are coming here to buy pharmaceutical, what we sell in the pharmacy and what we sell in the grocery store.
Yeah.
This was like, wow, tariff pass-throughs alive and well.
Wow. All right, a couple of things to unpack in there. One is so basically you're saying, look, if we look at the underlying inflation data, it suggests that disinflation or maybe even parts of the economy, outright deflation, are going on. Um, you mentioned shelter, right? So, shelter is such an important component to the CPI because Danielle, it's like 40% of the calculation, right?
It is indeed.
All right. So, you and I have talked many times in the past about how it takes a while for the housing to correct. It's one of the more lagging indicators in CPI, but that it was going to come down based upon in the past, more real time data that we had looked at. I had friends of yours, both Ivy Zellman and Melody Wright, on the channel over the past week. Both of them believe that 2025 will be the first down year in national average housing prices in recent memory, right? It's been a long time since we've had a down year. So, uh, there's a lot of housing analysts that say, okay, look, the gravity is starting to take over, right? We've seen it in a lot of markets already, Austin, Dallas, lots of places of Florida, here in Southern California now. but it hasn't brought down the national housing prices until it seems about now, right? So talking to Melody, I just did a great interview with her that's going bonkers right now on YouTube. And folks, if you haven't watched that yet, you should watch that one after this discussion with Danielle. And Melody is really having lots of shades of 2008. And as you know, Danielle, she got into this sector, into this industry from the mortgage side. That's really her area of expertise. She was at GMAC during the 2008 crisis. So she had like a literal front row seat to the mortgage meltdown. And she's seeing, a lot of echoes of that, to the point where she said, look, I think that housing prices are going to correct over the next couple of years. And I think the correction looks like it could be worse than what we saw in the housing correction of 2008. Now, I'm not asking you to agree with that or not, but it seems pretty hard to conclude that anything other than that shelter component is going to really be bringing CPI down for a fairly prolonged period of time from now, correct?
Yes, to Melody's point, and I think I was the first person to ever kind of meet Melody in the public purview. We've become such close friends, and I find myself doing my own housing research so that I don't just rely on,
Hmm.
gee, where's housing, Melody? But to her point that it could be worse, I don't, one of my main bodies of work has been demographics, but only in the sense of late that people who are, the median age of baby boomers is 71 years old, and they own 40% of the stock market. And this is why, the Fed cutting interest rates too much, it enters an existential risk into the rate cutting process, because you don't want those boomers to be like, okay, I was making 3.5%, happy as
Right.
a clam, and now I'm making 2%. Wait a minute. Now he's going to make me have to sell my stocks. So, but this same cohort owns 25% of the residential real estate market in the United States. Now, we were never concerned in 07, 08. I watched my mom's friends go be, one of my mom's friends went to go work at Southwest Airlines. I'm just going to go work behind the desk. And a lot of that generation, a lot of those boomers, they poured back into the workforce in 07, 08. It was their solution to, gee, my IRA just melted down. I better stay in the market. I better stay invested.
Right.
I like my house. I don't want to sell my house. I'm going to grow old in my house. Demographically speaking, though, there's a big difference between 2007, 2008, and today.
Hmm.
That same cohort finds itself, but it still owns a quarter of the nation's homes, and it owns 40% of the nation's stocks. And this this demographics for this cycle can finally count, in addition to the Airbnb jocks and people who cannot afford their homes, and the crazy FHA cash out refinancings that we're seeing that make
Hmm.
no economic sense at all. There's all the regular kinds of stress in the market that you would expect to see, but you have to put demographics on top of that.
So I talked in depth with Melody about this, and this is something that I've talked about with her and Ivy and a bunch of the housing folks that I've interviewed over the years. And I brought up this question, which I think you and I have talked about before as well, Danielle, um, about this sort of coming wave of just a 2 decade long or so unstoppable, unceasing selling headwind for assets as the baby boomers age out and are forced to start selling stuff. And that's just looking at their age. Now, to your point, you're saying, look, if we do things like start bringing down interest rates so that they're getting less of a return on their fixed income, well, yeah, that just ups the pressure to have to sell their assets there. Um, and I just want to note one thing about your comment about how much of the housing stock that they own. They do own that much, and it's largely because they're a big cohort, right? A big homeowning cohort. But they also own that much because they're the cohort that has the highest concentration, we'll say, of mom and pop landlords, right? That they bought second homes, third homes, they bought, other properties because housing kept going up and it was easy to rent it out and make money, right? So
Yep.
that as that cohort gets stressed, to your point, they're going to start selling, right? And the easiest thing to sell, right, is your second or third home, right? You're not, it's not the roof over your head. It's not the portfolio that you're depending on for, your fixed income. So that stuff can get dumped pretty quickly. And then, of course, once you get to the point where you're going into the nursing home or sadly dying, that house is in a high likelihood of getting liquidated, right? I made this point in my conversation with Melody, and then somebody on X actually went and pulled the research for it. I think it's something that over 70% of homes, when a parent dies, over 70% of the time, the house gets liquidated because the children can't agree on who's going to take the home or what's fair. So they're like, you know what, let's just sell it and then we'll split the proceeds evenly.
And that is what I just witnessed happen with a friend of mine in another state to the east. And it is what tends to happen. To your point about second home sales, just following Ivy's proprietary data. I mean, second home sales are in the toilet.
Mm-hmm.
And I mean, nobody's taking mortgages out to buy a second home. But you're absolutely correct. I do think that one mitigating factor will be that many of these of the adult children are already living with their parents or will be moving in with their parents as they begin to age. Once the math starts to get done about home health care workers or the cost of a nursing home or the cost of assisted living, and rather than age in place, which had been a phenomenon for so long. I want to age in place. I want to grow old in this house. Now you're starting to see more behavior as people push into their late 70s and 80s of I don't want a yard man anymore. I don't want there's all these cute little assisted living neighborhoods that are popping up that still give you the same sense of home and an individual place to call your own, but that don't have all of that baggage with them.
Right, they free you of many of the hassles of home ownership. Now, those things aren't cheap. And one thing that I'm, my personal opinion, curious to hear yours is, the baby boomers have, I can't remember the number, it's 70, some big number of trillions of wealth that they have. And everyone's expecting, well, okay, don't worry, because that wealth's going to get past the millennials and then they'll start spending it. And that wealth really doesn't go anywhere. It's still going to be available to be spent in the economy. And sure, that'll happen to a certain extent, but I would take the under in terms of how much is going to get passed from the older generation to the younger generation. And I'm not even factoring like a big market correction into that. It's just the cost of aging is getting higher. And so whether it's on healthcare, whether it's on assisted living, whether it's on end of life care eventually, which is where, the vast majority of the medical bills get ratcheted up. We may not see nearly as much wealth get passed along from the boomers to the millennials as most people think.
No, and whenever anybody always says it's going to be the greatest wealth transfer in the history of mankind, I'm like, yeah, if you knock off your parents. But and that's my very succinct way of saying what you just said, because people live for much, much longer than they used to, but it is really expensive.
The other thing too is I'm assuming in that number they are factoring in home equity, which is tied to the market value of the home. So a huge question is as you start having 10,000 boomers age out a day. Age out either means going to the nursing home or dying, right? Just as on the tail end, they're still hitting retirement age at the rate of 10,000 a day. Um, that that's just going to keep putting more and more and more inventory onto the market. And as you and I have talked about in interviews past, Danielle, it is a right now record unaffordability market. Millennials and Gen Z, they have a harder time affording a home today than ever. So as more and more inventory comes on, and again, I'm not even thinking about an economic slowdown or all the other things that could happen. It begs the question, so who is going to buy these homes from the boomers aging out at the prices that the boomers want for them,
Yep.
right?
And these are, this is what we described as the McMansion when they were being built or when they were having massive additions, built onto them. These are the McMansions. And it's a fact of life that the millennials have not replenished to any extent, that the birth rate among the millennials has not been anything like what it's been. And that gets you to thinking about, this cottage industry of, let's take a 2,500 square foot house and put lipstick on it and flip it. What happens when the price per square foot starts to really come down?
Hmm.
What are those ripple effects going to look like? Because the baby boomers aren't going to have a big enough audience to purchase these McMansions. They're not going to need all those bedrooms. They're not going to need all those bathrooms because they didn't have that many kids.
Right.
So, that disconnect, not only what will that disconnect cause in terms of home prices for the larger homes that are not necessarily desirable because they're really expensive to carry, but what will the ripple effects be once that price per square foot starts to come down?
So, it's interesting because I can hear two different voices going on from the folks watching this interview. And it all depends on, I think, where you are generationally. The older boomers are probably saying, yeah, that's a really big problem. And the younger generation is probably saying, I cannot wait for that day to get here. So
Well,
we'll see.
look, and that's, look, I'm going to digress for 2 seconds. Selfishly, I don't want for the Fed to ever even consider I mean, if there's one reason that I'm jumping to the very end and cheering for Christopher Waller, perhaps it's because he never would advocate for blowing up the balance sheet with mortgage-backed
Mhm.
securities purchases. He's not on, he's not the next Fed chair to inflate the next housing bubble. He understands that the zero bound does great damage to the housing market. And I'd be happier if the Fed was to lower interest rates. What does Treasury Secretary Scott Bessent want? 150 basis points and stop.
Yeah. I think
Stop.
that's what Besant wants. Trump, on the other hand, might want something deeper than that, but I think Besant, is a little more realistic. All right. So I want to get to Waller in just a little bit, but let me wrap up your macro
Mhm.
outlook first, and then we'll get to the changes at the Fed. Um, okay, so if I'm hearing you correctly, Danielle, and please correct the summary if it's wrong, but I think you feel that a slowing economy trumps tariffs in this situation, meaning uh, the risk here is the slowing economic growth, the increasing cracks we're seeing in the jobs market, the increasing weakness we're seeing in the housing market. That's the real thing to worry about here. That tariffs are probably not going to spark, a strong, sustained surge in inflation from here. And so I'm guessing you're probably in favor of a rate cut. Correct me if that's wrong. But that right now, I would guess you would tell people more like, hey, prepare for the risk of recession. Not that you're necessarily calling for one, but if you're going to prepare for something, prepare for the risk of a slowing economy and recession more than the economy heating back up and inflation running away again.
Well, so Adam, the beauty of me not quote unquote having to call for recession is that the data's already called it out for me.
Okay.
So, and this gets back to my point where there are probably a lot of Fed staffers who've been very frustrated as we've had one revision come out after another. According to the hardest data collected from 12 million US employers, net job destruction began in earnest in the second quarter of 2024. It continued in the third quarter of 2024. Looks like around the election, we stopped seeing net job destruction, but that we went right back in the first quarter of 2025. Again, this is not Danielle's opinion. This is just hard data. And so we know that the economy entered recession prior to jobs being destroyed. I mean, at least that's how it's been in the history of the United States,
Hmm.
and possibly came out of it and probably double dipped in 2025. And the work that we've done on state payrolls, which when you add up all of states' payrolls, as bad as that June revision looked on a national basis that took non-farm payrolls down to, I think, plus 14,000 total.
Mm.
When you add up all of the states plus Washington, D.C., They compile their payrolls a little bit differently. You get to negative 65,000 as,
Okay.
as a sum of all 50 states plus Washington, D.C. And in the past, when we've seen this pattern, and the aggregate of states tends to be more reliable than a largely imputed national number, in 67% of the time, we've seen the second revision. People are paying attention to revisions for once, but we
Hmm.
get June's second revision on September the 5th. It's coming right down the pipeline. And in 67% of the time in post-war history, when you've had the states aggregate to a negative number, you actually have that second revision for June that will be reported, print with a negative sign in front of it.
Come down. Okay. So you're taking the under on the September revision for June jobs.
Yes. And
Okay. So
actually, that's data that Powell had in hand when he hit the podium, because states' payrolls data had hit about 48 hours before he took to the podium. So he knows he knows that he's likely staring down the barrel through the rearview mirror of an actual negative print in non-farm payrolls.
non-farm payrolls. Okay. So couple things. First off, who compiles all that state data? Is that a regular report, or is that something that you have to get in
No.
the bell?
This is released by the Bureau of Labor Statistics 2 weeks after the main payroll report. This is a matter of public purview. Um, and by the way, that first negative print, if it does come to pass, will be the first in 15 years.
Okay. It'll be the first negative print in 15 years. Okay, so very substantial. Obviously, the kind of thing that if Powell had in his hand would probably influence him to start messaging to people that, okay, things are about to get worse, right? Which is sort of what happened on Friday. Um, I don't want to rat hole on this, but uh, your very quick reaction to the fact that for a good long while now, many of us, you very much so, have been very vocal about how specious the BLS data has looked, especially around jobs. A lot of debate on it. How accurate is it? How much can we trust it? We've talked in the past with Neely Taminga about how maybe not necessarily done for nefarious reasons, but just the bullwhip effect caused by the massive amount of firings and the massive amount of rehirings during COVID ripples through the system, and it just puts a lot of dust in the data. Um, you know, we've railed about that, but then we had the president come out recently, angry about how trustable this data was as well, and then fired the head of the BLS. It's funny because Powell obviously wanted the numbers to be better than they were reported, where a lot of us had thought the numbers were worse than had been reported. But any high level thoughts on just sort of the quality of the data right now?
So, it, I see the firing of the head of the BLS as highly unfortunate, because what was going on predates her. Either the model is broken or it's been politicized. Any way you slice it, in the 30 months ended June of 2025, 24 of them saw negative revisions.
Mhm.
It's just a big number, Adam. It's a number that kind of insults you if you stop and say, okay, it was only 2.5 years and just 24 out of the last 30. No, it's a big number.
Yeah, and it's hard not to see a bias in that, right?
At least a bias or at least an acknowledgement that, whoa, if we've got 24 of the last 30, something's broken in how we're coming up with these data.
Mhm.
And so what we did a few weeks ago was we actually tried to anticipate your question, because, and this happened exactly when the head of the BLS was fired. I said, how long has this been going on? And the answer was the last 24 months. And it just seemed, they don't make a distribution, they don't make a bell curve with that long of a tail
Mhm.
for it to be statistically possible.
Possible. Well, then I'm curious, and again, I don't want to rattle on this, but do you think there's intention behind it, or do you think it's just a tough environment to make accurate estimates from?
So I will make this as brief as possible. my head was spinning when July of 2023 was revised upwards, only because it broke a long streak at a time when it didn't feel like the labor market was getting any better.
Mm-hmm.
And digging into those weeds, lo and behold, I find out that that upward revision was all government jobs and then some. And that in
Mm-hmm.
fact, that month had been revised to the negative in the private sector. So that kind of stuck in my craw. And I said, well, God, that doesn't sit right. But again, it was just something you note. I mean, everybody knows 1 month does not make a trend. On the other hand, I was like, sure is convenient to have those government jobs there to break that streak of negative revisions. So yeah, in walks August 1st, and Anna Wong saying, well, it sure does seem funny that more than half of those negative revisions came out of the government sector,
Mm-hmm.
not a surveyed area. They just pull those numbers directly from government agencies, not a matter of public knowledge. You don't actually get to see the numbers, but it sure does seem suspicious that more than half of the downward revision in this instance came from the government sector. And remember, severance doesn't end until September for this huge wave of
Right.
employees that accepted the buyout offers, et cetera. It wasn't that. And so Ann and I have been talking quite a bit about this, and it just using the government sector really, it's very bad optics. That's the kindest I can put it.
All right. And just to be clear, when you say using the government sector, do you mean the BOS was padding the government jobs numbers to make things look better than they were, or that the government was actually ramping up hiring to try to counterbalance what they maybe feared was a slowing private sector?
In July of 2023. Well, I don't know that I'll ever know. I don't know that anybody at the BLS is going to call me up and say, hey, I'm having this holiday gathering. I really want to tell you what happened back in July of 2023. Or, hey, I really want to tell you what happened in May and June of 2025 and why all those jobs disappeared from the government sector. I don't think anybody's going to be whispering in my ear on that one, Adam.
All right.
I do find it to be suspicious.
All right. Well, on the chance anybody from the BLS is watching right now, I highly encourage you to whisper in Danielle's ear, but we'll see what happens. Okay, gosh, you keep raising. There's still so much more I want to get to, which we will. But I want to ask you a question about Anna, and I will in just a second. But before I do, let me get to the key question I was trying to get to, which is you talked about, hey, you don't even need to make a call for a recession. By the metrics you walked us through, the economy has been in recession. It sort of double dipped over the period you were talking about. Question for you, Danielle. Despite that, so some might say, oh, okay, well then maybe we've been in it and then we're going to get out of it and that'll be good going forward. I get the sense you're saying, oh, it's going to get worse from here. That accurate?
I don't see the private sector engaging yet, Adam. And that's what it's going to take.
Mm-hmm.
There's no way it doesn't get worse when 250,000, call it more or less, government employees come off severance at the end of September. You can't tell me that's not going to leave a mark of some kind.
Yeah.
Talking to coaches, when I say coaches, this is not, I know football season's upon us, go Horns, our champions are out there, knock wood, etc. When I'm talking to career coaches, there are opportunities for making healthcare more efficient with AI. There are great opportunities for extremely well-educated people, and we're talking about PhDs here,
Mm-hmm.
who are smarter than AI, and those opportunities aren't going anywhere. Everything else, they continue to see job losses.
And I again, don't let me say things that aren't true, but I get the sense, Danielle, that you expect the unemployment rate to rise, not fall, nor even stay flat over the next 12 months, correct?
That is correct. We have seen the unemployment rate never gets revised. In October 2013, the response rate was 90.1%. In July of 2025, the response rate was 67.1%.
So crazy.
This number is never revised. However, we do know that University of Michigan has more than doubled its sample size, and that the percentage of Americans who believe the unemployment rate is rising in the coming 12 months, higher unemployment expectations, which has never come unanchored from the unemployment rate ever. And we're talking about UMich goes back to 68. Thank you very much. It has completely come unanchored at a time when the unemployment rate response rate for the survey has gone from 90 to 67%. And meanwhile, UMich has seen a doubling in its sample size to gauge Americans' perceptions of the strength of the job market, which remains north of 60%. More than 60% of Americans see the unemployment rate rising in the next 12 months. You can't tell me they're all crazy.
Yeah. All right. So I get, I've had some conversations recently where, uh, I try to call balls and strikes as I see them, the good data, the bad data. And I've had people at times say, Adam, you just don't get it. I mean, jobs market is just terrible, right? Like, and I don't disagree that it is hard for a growing number of people. I'm just not willing to say it's terrible yet because I think we are on our way to terrible, and I want to choose my words accurately. And look, I mean, I shouldn't say terrible, but I think we're on our way to worse, and it could get to terrible. But I think if you don't like where the jobs market is right now, I don't think you're going to love by any stretch where it's going to be 12 months from now.
No, I mean, we haven't had that break point. And I mean, even though we're at 1.97 million continuing jobless claimants, states are being very stingy with who they allow to get through the initial claims process.
Hmm.
They're rejecting quite a few of these people. And we have this massive gig economy that's acted as a huge shock absorber,
Right.
which means, and companies have not let go of their best employees. In fact, they're
Right.
trying
We haven't had job shedding yet.
no,
Yeah.
we've had, well, Adam, yes, we have,
Okay.
reducing headcount.
Right. I'm sorry. Let me just to clarify what I mean by job setting so you can clarify in your answer. We have had job hoarding over much of the past 5 years where companies have been hiring people that they don't even know how they're going to use. They just don't want them to go to their competitors, right?
Yep.
I consider job shedding that watershed moment where they say, all right, you know what? We're not keeping these people around anymore. So I
Yep.
agree with you that there's been lots of, hiring freezes and selective layoffs and let people attrite and all that stuff. But I don't think we've gotten to that tipping point where it's
Yep.
like, we got to clear out the deadwood. You sounds like you agree.
100%.
Okay. Okay. All right. Okay, macro wise, I'm putting words in your mouth, but Danielle says, expect things to get worse before they get better, folks. Um, Let me ask you a question about Anna, and then we're going to get to the intrigue at the Fed. And then I have one concluding topic I want to talk with you about that's orthogonal to all this, but I think you're a great person to ask about it. Um, gosh, I talked to Anna, I think at the beginning of this year, near the beginning of this year, and she was the first one to really put on my radar her concerns about of student loans going back into repayment
Hmm.
because it was the last major form of consumer debt that was getting out of its moratoria. And of course, it's the one you have to pay. It's the one the government won't let you get out of with bankruptcy. They'll garnish your wages. They can just take it if you're not paying them, right? So all of a sudden, you've got 60 million borrowers who went back into repayment, many of whom didn't think they were going to have to. They trusted the previous administration that a lot of that was going to get forgiven. So they'd expanded their lifestyle spending, and they weren't reserving that money anymore. Now all of a sudden they got to pay it back. We know at least 10 plus million or so are having a real hard time doing so because the delinquency rates on these loans has skyrocketed. And more importantly, we're seeing the delinquency rates of other types of consumers that start to follow because, hey, if I've got to pay back this student loan and I don't have that much left over, I got to scrimp and maybe be short on my credit card payment this month or my auto loan or my mortgage or whatever, right? How big of a factor is that, do you think? And do you think that shoe has dropped, is dropping, or is it still ahead of us? The impact of it.
I think that it is the slowest moving dropping shoe in the history of mankind.
Okay. So slow we shouldn't worry about it, or
Oh no, no, no.
okay.
I wouldn't go that far, Adam, but it has definitely already been visible you're seeing a lot of purchase applications to buy a home, and yet you're not seeing home sales match up that application volume. We witnessed a similar phenomena in 2007 because people are putting in multiple applications to buy things because they're being rejected, which is not a good sign.
And just to connect the dot for folks, because more and more people are getting delinquent on their student loans, when their loan goes delinquent, their credit score gets whacked pretty hard. And that's what's going on right now, right?
Right. And so they're looking at this bank or that bank. Oh, they're not going to give me the home equity line of credit. I'll go to this bank.
Mm-hmm.
Or they're not going to let me buy the house. I'll go to that bank. So we're seeing that there are a lot of individuals right now who are simply not paying these loans. And there have been some good stories written about them. And they're like, yeah, as I always say, when it comes to the inflation argument, you can't squeeze blood from a rock.
Mm-hmm.
That's what they're saying about their student loans. They're like, I got it. I've got this obligation. I don't have the money. I'm not paying it. Well, a lot of these individuals, maybe they can live off the grid forever. But if they're in lower paying industries and they don't come back onto the grid, let's just say they're a contract worker for Uber. But if they've been stretched and their budgets have been crimped, the one thing they're going to do at the very, very beginning of February is run out and file their taxes. They want their tax refund. So either the realization comes slowly as it's coming.
Mm-hmm.
If you're on the grid, your wages are officially getting garnished if the government can find you, or it's coming on tax day.
Right. Meaning you're expecting your tax return, the government's going to say, wait a minute, we need our pound of flesh first. Yoink.
Oh, it's
You're
not a
getting
pound of flesh.
less than you thought.
They will take the entire tax refund.
Yeah.
So it's more of a snowball effect into tax season. So people are realizing, oh my God, I can't buy this, I can't buy that, I can't buy that. I don't have access to buy now, pay later anymore. They're actually sending things in to check my credit. My credit card line has been cut. I can't turn in my car and buy a new car because my FICO scores come down. So the fallout from student loans is going to be steady, but it will crescendo around tax time.
Okay. All right. So a slow moving but very important development to keep our eyes on here. Okay. So let me get over to the Fed specific questions. So first off, looks like Trump is not going to try to replace Powell before his tenure ends, which I think is the right thing to do. And it was kind of crazy to think about ousting a sitting Fed chair because it's really hard to do that. And it would have been disruptive in a way that probably wouldn't have helped anybody. But a lot of speculation or now on who's going to replace him. And it's interesting because for a while, it was basically down to Waller and Warsh, right? But then all of a sudden the field got expanded again. So where are we in terms of who is the lead horse right now to replace Powell?
Well, we could be looking at a universe that really only has one potential person to come in. The Supreme Court carved out Fed officials who've been confirmed by Congress. That includes Lisa Cook. There's no guarantee that she will leave. There is no guarantee that Powell will leave. He can stay through the end of January 2028 if he so chooses to do so.
Okay. Stay on the FOMC, but won't be the chair, right? Yeah.
Right. If Mirran gets confirmed, then it could come down to something as simple as, President Trump saying, I didn't like that Mirran guy in the first place anyways. So let his term end in January, and then I'll put whoever's going to replace Powell in then.
Okay.
It could be that undramatic. It could come down to just a party of one, or moving Mirran out and moving somebody in. We don't know.
And let's assume that happens. That's somebody who comes in January. If they're sort of looked at as the de facto next head of the Fed, does anyone listen to Powell anymore? Or do they just listen to that guy?
Oh, I think the listening ears I think the minute Mirran gets confirmed, that you're going to have a lot of people not listening to him and
Not
making
listening to him being Powell.
being Mirran
Oh, Mirran, not listening to Mirran.
and making a point of it.
Okay. Interesting.
Well, now, Adam, you're talking about, I don't have my PhD in economics, but I can tell you people who do,
Mm-hmm.
they hang their hat on it, and they are not going to sacrifice their academic integrity for some political patsy. And that's how they're going to see it. So for them, rather than the camaraderie and being respectful of the chair, being able to bring, as Goolsbee said in Jackson Hole, bring them all together, one big happy family, lots of disparate views, and yet Powell's done a magnificent job of holding us all together. I think if you have somebody come in there and try and strong arm their views, that Powell might have world's most supportive committee through the end of his May term, and possibly even after it, just to stand on principle.
Just to make the point.
And that, Adam, actually is why Treasury Secretary Bessent has had to widen the net of potential Fed replacements for Powell, because a lot of economists right now are saying, I don't want to be appointed as Arthur Burns Jr. I don't know that I want to put that on my resume.
Okay. And so the FOMC historically has really tried to have unanimity in its votes, right? Dissents are, until recently, rare. And usually it's like one member, right? So I guess what they're afraid of is you could kind of have an FOMC table that boycotts the new Fed chair, right? And says, hey, look, I don't care what you want to do. We want to go against you because we don't want to look like we're political patsies like we think you are. Yeah. And I'm just curious.
It would be more respectful than that, mind you. But again, it's the staff that runs that show, not people who go through some 14-year revolving door. The staff have probably been there since, Lincoln was in office.
Okay. But how does the FOMC vote go, though? In other words, is it just whatever the majority decides, carries the day in terms of the decision making, or does the Fed chair have, sort of super voting rights, or how does it all work?
So the Fed chair has traditionally been able to sway the voting. Famously, Fed Up opens, and Bernanke has somehow talked Richard Fisher into switching his vote at a critical time when the zero bound was about to be set for the very first time in U.S. history. The chair always has sway and is expected to hold the same sway that any leader would hold. But in this type of an environment, dissent itself might be what the 12 voting members of the 17-person committee, those 12 voting members might see their votes as being critical to safeguarding Federal Reserve independence.
Mm-hmm. And if the new Fed chair comes in and says, everybody, we got to do this, and everybody else dissents, obviously everybody else carry the day on that, right? He unless he can be convincing, his vote doesn't somehow supersede theirs.
I would add to that ceteris paribus, because if the economy is weakening appreciably, if, as Powell said, the unemployment rate can go up really fast once it starts to rise, which he said at the podium.
Which it always does, by the way, and we've talked about that a lot, but yeah.
And if that happens, you will have most of the 12 voting members advocating for rate cuts, but you won't have anything radical going on. I think that most current members of the committee don't think that the zero bound was efficacious.
They feel like they sort of learned their lesson on that. And I've heard that over the years since, that returning to ZIRP, not very politically palatable. Maybe even returning to QE would be something they would do much more reluctantly than they have in the past, because it's much more widely accepted now that just really stoked, wealth inequality. I still believe that the Fed would go back to those things if it felt it had to, but maybe a little more reluctantly than in the past. All right, let me try to chop some more of this wood. So assume for a moment that rate cuts do come. We get a rate cut in September, followed by, let's say rate cuts for the next, 5, 6 Fed meetings, right? What will that do to bond yields? Will bond yields come down the way that everybody, is hoping and thinking they will if the Fed starts cutting, or may investors be surprised?
You mean, will investors be surprised again? Yeah.
Yes, because we had this happen when the Fed cut by 50 points back in September. Everybody cheered that, and then what happened? The 10-year went up. Yeah.
So I really do think that that it will depend on the data, but I think that within a heartbeat of the September the 17th meeting, again, you're going to have a wave of federal employees coming off severance. Things are going to be getting worse in housing. Things are going to be getting worse in the student loan arena. It's all going to be incremental. By the way, the lag effect of the Fed being high for longer, it has yet to sing its last song. It
Bless you for saying that.
it continues to blaze a nasty trail through the bankruptcy courts. And so all of these things will be incremental to keeping the easing going, such that we're going to have a much more plain vanilla type of easing cycle, one that is accompanied by a steepening yield curve, but nonetheless falling bond yields.
Okay, so that's where we're going. So you think bond yields will come down, and I guess just to re-ask the question a different way, it sounds like you think that the current bond market's concerns about tariff-driven inflation will give way to its concerns about the slowing economy, and we'll see more of a safety trade going in with treasuries.
Yes, that is what everything in the macroeconomy right now is telling you. It's going to go down kicking and screaming, however, because we've never had 50 some odd percent of the bond market volume be dictated by a handful of really large hedge funds that happen to be short the 10-year, or short the belly. So there's been a huge technical aspect to the last year of bond trading that is more reflective of, damn it, this is what my position is. So this is where bond yields are going. And if I have to tap somebody to sing my narrative about tariff inflation, I'll do so, at least until I make my next trillion. And then I'll move on.
Interesting. I wish we had more time to explore that in real depth right now. But at a cursory level, do you think there's potential then for those guys to get squeezed at some point as yields start to come down, where, at some point there might be a real pop in bond prices as those guys perhaps maybe get forced to exit that trade?
Um, Adam, I think that might be a story that's floated out there, but something tells me they'll be in front of the next.
Okay. Okay. Yeah. Well,
Well,
bond investors tend to be
that
the
was
smart money.
cynical, but okay. Yep.
Okay. All right.
I look back to a firm that was buying and selling something called subprime at the same time. I can't remember what the name of that firm was. Anyways, stranger things have been known to happen on the old street.
Okay. All right. Well taken. Real quick, just back to the Fed for a second, because I realized I forgot to ask it. Is there any reason to watch closely what happens with Lisa Cook on the FOMC, or do you feel like whatever happens there, it's not going to matter all that much?
Um, I think the Cook matter is more one of simple mathematics. If he's got Bowman, if he's got Waller, if he's got Moran, and then if he can replace Cook, and if the true doves are truly dovish, Collins, Goolsby, then you could set up a situation, Adam, in which you did have a majority who were in the easing camp, some holistically, some organically, some because of politics.
Mhm.
I think the Cook swing factor is much more so, is Trump going to have two individuals and then possibly three if Powell does leave? And then the math starts to, then you do start to worry about the Fed being a malleable entity.
Mhm.
Now I'm hoping that a bunch of bureaucrats decide to stand on principle.
Okay. And that's sort of where I was going with this, is if the math went that way, everybody, a lot of people criticize the Fed for already being politicized, but I think we would have a much more politicized Fed if the math actually went that way. So you're kind of hoping for whatever it takes to not let the Fed get even more politicized.
Potentially, yes. And bear in mind, you know, we've been going down this path for a long, long time. It took then Vice President Kamala Harris to cast the swing vote in the Senate to get Lisa Cook confirmed in the first place, because she was a political appointee. So let's not throw stones in glass houses here, please.
Okay, good reminder. Okay, before I get to our big last question, let's just trundle through your market outlook for a moment. I got to imagine, looking out at the next year, you're probably not that sanguine about asset prices, both given the economic slowdown forecast that you have. Plus, I'm speaking for you here, but I'm sure you're concerned just about today's high levels of valuation. We're back to kind of crazy animal spirits, in some metrics, record levels of valuation. So dangerous cocktail when you have that much speculation in a market that looks like it's going to be slowing for the next year. If I summarize your outlook correctly there, anything specific you want to share about how you're looking at the markets in the near term? And are there any strategies or assets in particular that you think are wise to consider given where we are right now?
So, Adam, until momentum breaks, it ain't breaking. And so I can tell you that looking back over the last year, because valuations have been kind of haywire for a very long time, they are not timing mechanisms. What I've really enjoyed owning are my high-paying staple stocks, high-paying dividend staple stocks. I mean, I sound like a grandmother, but I don't mind the income stream that comes in with them at all. I haven't minded the 3.5% on a high cash holding. I haven't minded a lot of my municipal bonds that are throwing off cash. Do I keep saying cash? Yeah, I'm repeating myself. But
Well, income is what I hear you saying, cash and income, but yes.
So I haven't minded that, and I won't going forward, because I like the idea of companies that have sufficient cash flow to not cut their dividends and or service their debt.
Okay, so basically, play it safe, not get totally out of the water, but look for safer players that have the stability you're talking about that give you dependable income.
And if you want to aim for the fences, then look and see what collapsed in April. If you want to play on the other side of the market and buy some puts, go look at the sectors that underperformed at the greatest extent in April.
That'd be what, like the Cathie Wood type stocks?
Sure. And, some of the other stocks and other sectors that tend to be less liquid when liquidity dries up.
Okay. One thing I'll say about puts, which is, look, it's always a good idea not just to have diversification in your portfolio, but to have some downside insurance. Danielle, I think recently the put to call ratio has been, near all-time lows, or at least, very depressed, meaning essentially that downside insurance is pretty cheap right now.
Pretty cheap.
Yeah.
Pretty cheap.
So, it's always good to have insurance, and it's even better to have it when it's cheap. And it's good to have it in place when you're at an extreme, kind of like we are from a valuation speculation standpoint. So I would imagine you would say, if you don't have, downside hedges in your portfolio right now, it'd be wise to consider getting some.
I mean, at least we've covered the buy low portion of the equation, right?
Yep. Okay. All right. Well, thank you. Okay. So in wrapping up here, is there anything else that is burning really brightly on your radar that I haven't thought to ask you about yet?
The only thing I would say, and because there's been a very tragic tragedy in my life. A friend of mine very recently you cannot take being a friend or being charitable at economic times like these lightly. Check
Mhm.
on your neighbors, check on your friends. You don't know how this economy, I can talk about underemployment all day long because underemployment's a real thing. But you never know how much somebody who might even be close to you is really struggling. Check on your neighbors, check on your friends.
Wow. Yeah, I'm so glad you said that, and it's so interesting because I record a weekly, market recap with Lance Roberts every week, and at the end of these recordings, we kind of go off into some sort of human interest area, and the one from this past weekend was exactly that. Kind of the focus was on having grace, having grace, and yourself, but also try to acknowledge when you see people who are struggling but getting through it gracefully. But the point being is that everybody's going through something, and a lot of the times we can't see it, we can't imagine it, and there's a lot we can miss. And in the course of the discussion, we talked about a few people who were really going through some tough times. I'm very sorry to hear about your friend, but I can't echo and emphasize enough what you've said. So thank you for sharing.
Thank you, Adam.
All right. Well, look, Danielle, last and most important question. For folks that would like to follow you and your work in between now and the next time you come on this program, where should they go?
So, definitely come join the Daily Feather Daily Party, DiMartinoBooth.substack.com. And a big shout out. I had a pro walking off the street, which actually sounds like I'm talking about a prostitute. No, I had an institutional product come, a new client come in today, and that was also very refreshing. For you institutions, we just had our 10-year anniversary of founding QI Research. We've been publishing the weekly Quill flagship for more than 10 years now. We have a very exciting Bloomberg chat room. So whether you want to read me every day at a lighter level or you want to become part of my institutional client family, then just come find me, QI Research.
All right, fantastic. And Danielle, when I edit this, I'll put the link to your Substack and all your subscription options up on the site here. Folks, I'll also have the link in the description below this video so you can get there with one click. All right. Well, in wrapping up here, two quick things. One, just want to remind people that the Thoughtful Money Fall Online Conference is now available for ticket purchase. We've actually seen a really strong initial response to this. I think people are really beginning to gear up that things are going to start getting pretty rocky in the way that Danielle has shared for us here. This is going to be a fantastic lineup this year. In fact, it may be our best lineup ever. I've mentioned some of the names already. Lacey Hunt will do his traditional excellent detailed keynote. We'll have James Grant, the godfather of interest rates. We'll have Judy Shelton, and she'll definitely tell us the latest on what's going on with Fed and Fed policy. We'll have Michael Howell with liquidity, Darius Dale with all of his market forecasting, Stephanie Pomboy and Grant Williams together doing their dynamic duo on where things look like they're headed in the macro side of things. A number of other guests that I'll be announcing very shortly. But it is just like I said, shaping up to probably be our best conference and maybe most timely important conference ever. So if you want to sign up for it and lock in the low early bird discount price that we're offering, it's the lowest price discount we're going to offer. Run, don't walk to thoughtfulmoney.com/conference and lock your ticket in there. And as a reminder, if you are a premium subscriber to the Thoughtful Money newsletter, our Substack, you have a discount code that I've sent to you that will give you an additional $50 off that lowest early bird discount price that I mentioned. And if you aren't a subscriber yet, but you want to become one, even just for the month, to lock in that $50 discount, go for it. Only costs 19 bucks a month. So if you pay the 19 bucks, save 50 bucks, you can just pocket that $31 difference. And I'm happy with that. I want everybody possible to get the lowest price they can. Also, if you are, processing what Danielle mentioned in terms of, her forecast on where things are likely headed, both economically and in the financial markets, and thinking, wow, I really might want to have some help in figuring out how to navigate what may lie ahead here. I recommend that most of the people watching this channel get that help from a good professional financial advisor. If you've got a good one who's, taking into account all the macro issues that Danielle mentioned, and creating a strategy for you and then executing well on it for you, great, stick with them. Don't mess with success. But if you don't, or if you'd like a second opinion for one who meets those criteria, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. These consultations are totally free. There's no commitment involved to work with these firms. It's just a free service these firms offer to try to be as helpful to as many people as possible. All right, Danielle, look, it is always fantastic having you on. Thank you for being so generous and so detailed in sharing all your insights with us. It looks like it's going to get to become a bumpy, wild ride from here. And I hope you'll come back on frequently to give us, real-time updates as to where things are headed as events play out.
Of course, be happy to.
All right. Thanks so much, Danielle. Everybody else, thanks so much for watching.